Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This is a podcast from HSBC Global Research, available on Apple Podcasts and Spotify. However you're listening, analyst certifications, disclosures, and disclaimers must be viewed on the link attached to your media player.
Hello and welcome to Under the Banyan Tree, where we put Asian markets and economics in context. I'm Herald van Linde, head of Asian equity strategy here at HSBC in Hong Kong. Fred's traveling this week, I believe he's in Europe, but I'm very happy to be joined by his co-head of research here in Asia, a gentleman named Eliot Camplisson, who heads up our equities coverage in the region. Now, unless you've been living under a rock, you're probably aware that US tariffs have been completely dominated discussions on markets and economics around the world for at least the past month or so. And make no mistake, this is the biggest story to play out in the global business stage in years. But are we missing the bigger picture? Have we become so fixated on tariffs and all the numbers, is it going to be this much or that much, that we've lost sight of some of the macro and micro drivers here in Asia that give our economy so much promise and resilience? Well, we think so, otherwise we wouldn't dedicate a podcast to it. So that's what we're going to discuss here today. Without further ado, let's get the conversation started under the banyan tree. Well, since our resident chief economist is away and Eliot and I are here, I think we should start with a look at the markets for some context. The two economies front and center of the trade discussions, of course, are the US and China. Unsurprisingly, they've fallen, but actually not by a huge amount. At the time of recording, the Hang Seng China Enterprises Index, it's abbreviated to HSBC, and it's basically the mainland Chinese companies listed here in Hong Kong, and the S&P 500, the index for the broader market in the US, are down around 4% and 3% respectively since the US tariffs came into play on Liberation Day, April the 2nd. But it's a very different story for much of the rest of Asia. Korea is up 6%, Japan is up 5%, India is up 4%, and Indonesia is up 3%. So at this point, I want to bring in Eliot. Welcome, Eliot, to Under the Banyan Tree.
Thank you very much.
Now, Eliot, if I would have asked you last year, what do you think is going to happen with the Chinese stock market if the US is going to impose 125% tariffs on it? What would you have said?
I would have said exactly what happened in the first 4 or 5 days after the announcement came out of the United States, which was a very fast, very dramatic fall.
Yeah.
I would obviously have listened to you to stay calm. And what's been incredible is, we've bounced back a long way. And I think just to go back to your points you were saying about, let's just talk about the US and the HSBC, because I think they're nice, reliable, liquid proxies for this kind of opinion coming out of the market. And you said, HSBC is down 4, US is down 3. Yeah. But don't forget where we were before. The US had already been rolling over and Hong Kong had been very strong going into that event. So actually, if we look at year to date, including the whole thing, Hang Seng is up 10, roughly, and S&P is down 6. Yeah. So we've ridden out the storm way better than even I, an optimist, would have expected. And to put in context what you were just saying, you asked me that question this time last year. This time last year, you and I were in China.
Actually, we were in China, that's right.
Seeing clients. And at the time, the feeling when we went to see investors there, I think if we'd have told people, listen, we've got a crystal ball tariffs April 2nd, I think they would have run for the hills. They would have been so scared because things were so tough. So the way we've ridden this out, I think, is really a surprise, even to an optimist, let alone to people who were pessimists in April of last year.
Yeah. Now, there's one thing that's interesting which came up from last year, and you actually brought this up in a meeting we had earlier this week, is that when we were in China last year, we were traveling, seeing clients in Beijing and Shanghai, and they say, what is the foreign investor doing? When are they coming back? And what is their opinion on China, right?
And we weren't very popular because we said we don't think they're coming back.
Yeah, exactly. But what we've seen is that they've been looking for the wrong investor to arrive. It's the local regional investors. So it's been southbound flows that have been incredibly strong in Hong Kong.
You and I have done this a long time. You know, what's so exciting, what's happening at the moment is I feel like genuinely in a really structural way that Asia is buying Asia.
Yes.
We don't need to wait for the rest of the world to come in, you know, from Asia financial crisis in 97, where foreign investors leaving precipitated that terrible fall, and bouncing back from 2008, we needed the US market to recover. What we're seeing now is the US can be down and Asia can run on its own steam and under its own energy. And you've talked so much about the pile of cash that's sitting in Chinese current accounts.
22 trillion US dollars, yes.
Amazing.
Yeah.
And, you know, the pension funds growing in Malaysia, for instance, or, you know, Singapore's own long-standing funds. Yeah. And they are the ones who are coming in. And I don't know the exact numbers, but I think the numbers of US investors in China markets is still very low.
It's very low.
And we've held up. And I think this is being missed in the bigger picture is there is a strong capital base here.
That's right. And actually, this could only be further amplified because if the Asians, the households that have put money into the US over the last couple of years, that's in particular Japanese and Korean households, as far as we've seen data, they're bringing this back. So this is going to come back into Asia. It means that there's more capital available, and that's going to be supportive to markets. So that's good. It means for us, for example, the clients that we talk to is going to change as well.
And I think the other exciting, you know, I know we're here to talk about, you know, riding out the tariff storm, but something that we really do need to talk about is, again, something that was very difficult to talk about this time last year, which was the number one question before we're all talking about trade now, which was property. And this was, you know, this was going to end the Chinese economy and there was no way to come back for it. And the pictures in the magazines of thousands of empty apartments and that's it. It's all over, done, finished.
Yeah.
Okay. So I'm just looking at some of our most recent work in China property. Yep. So 14 out of 80 major cities inventories are down more than 20% in the last 12 months. I think inventories in Shenzhen are down by 50% and are down below 8 months of sales. Yep. This is a huge, huge change. You know, this was the driver of the economy. This is what brought us down. And what we want is a stabilization, and that's what we're getting, and that has a huge knock-on impact to confidence. And like you say,
and that goes into people being willing to take on risk to buy either a bit of property or equities or bonds or whatever it is. So that gives that confidence. But I think there's a bigger thing going on as well. There's a lot of focus on these tariffs, but it misses kind of the picture to a certain extent. If you would have had in the US a policy whereby they say on Monday we're going to impose tariffs on Chinese products because we want to have production being based in the US, that's good. But then what on Tuesday you should have done is to say, okay, anybody wants to produce these sort of products. And I think what are the key products that's going to define the rest of our lives? It's going to be AI, robotics, EVs, certain high-end healthcare. You say to all of these sort of industries, you invest in the US, you get all kinds of tax breaks and we make it easy. We're going to set up a national research department that is going to help you out, all that kind of stuff, right? Then you say, okay, now you have something really powerful, but that so far hasn't happened yet. Meanwhile, China has done that. Over the weekend, they had a big meeting about AI, was chaired by Xi Jinping himself. And what I now see is that in those industries that I just mentioned, we actually see China starting to take a lead. In EVs is leading. In robots, not in humanoid robots, but in industrial robots. In AI, not really yet. DeepSeek came later than ChatGPT, but we're talking about a couple of months difference here. And in healthcare, we see companies emerging as well that are globally competitive. So I think China is almost using this as an opportunity to rise. And maybe what we can even say is that this has been an incredibly costly way for China to do so. It had overcapacity in all these industries. The local governments finance that. There's a lot of debt there. We're talking about $6-7 trillion US of debt. But now they have some companies that are globally competitive, right?
We know they are in EVs. We know CATL dominate in batteries and BYD do their own batteries. Just today we published something. I'm going to read this out. Neither of us are going to understand it, but it sounds really good. Okay. Baidu introduced Ernie 4.5 Turbo. Baidu revealed that Ernie 4.5 Turbo's multimodal capabilities are on a par with GPT 4.1, but priced at only 0.2%. 0.2% of GPT 4.5. Now, that's a technical sounding way of saying China can do this very, very cheaply and help companies deploy AI at scale very quickly without as much cost of subscription. We can get into a different argument about monetization for these things, but they're just going to run and you're going to see it in what you're doing. We've done other work where we're looking at real life examples of photo editing suites for apps where you're buying clothes and then you can see yourself in the clothes. You take a picture of yourself and it AIs those clothes onto you, but not just in some sketchy, looks terrible way. So we're seeing this monetization happen already. So it's, we know it's already happened in EV. It is going to happen in AI. And we're seeing it everywhere. And like I say, I want to stress this again. If we see property hold a base and that confidence comes back, we know what they can achieve in China. And it's
impressive. And they have the capital to do so, because we just spoke about this as well. So these Chinese companies, they are going to be world-class leaders in their respective industries and will be able to head-on compete with anybody else that's around the world there. The question then is, for the rest of the region, what can these companies do there? And we're going to talk about that right after the break. Eliot, while we were having this break, you actually pointed out something I actually forgotten about, something interesting, the listing of these stocks.
So, there's been a lot of concern from clients been coming to us, worried about mainland China companies that are listed in the US having to repatriate, and that this could be very disruptive to the markets. Actually, underlying that is a really positive thing. So Alibaba, 2014, I think biggest IPO in the world at the time.
At the time, it was the biggest IPO in the world, yes.
And listed in the US.
Correct.
Now, what's the underlying message there is, if you want to do something big, if you need a lot of capital, if you want a lot of liquidity in a stock, you've got to go to the US. And in 2014, that was clearly true.
Yeah.
Okay. So in 2019, Alibaba do a secondary listing in Hong Kong. And what's interesting about that is, as of today, and this is, don't forget at the beginning when it just listed in 2019, we had all the mess of COVID. As of today, almost half, about 40% of the trading value of Alibaba is now in Hong Kong.
Yes. That was 100% actually
and that
in 2014.
Was 100% in 2014. It's now 40% in Hong Kong. If you look at a company like NetEase, it's almost half. If you look at Trip.com, it's almost half. Li Auto, it's now more in Hong Kong than it is in the US. Again, why does this matter? To go back to the point about Asia can look after Asia. And that really is something very, very different to the last cycle.
Yeah. Asia is buying Asia.
Asia is buying Asia, and we can provide the liquidity. So, it's interesting. Everyone's worried about this delisting thing. And actually what they're missing, I think, is a really important underlying trend is the liquidity is here. The capital markets are big enough here. You and I don't talk a huge amount about bonds, but throughout the last year or so, China bond spreads have been incredibly tight because there is so much capital in that market looking for opportunity. Yeah. And with the property companies gone, in a sense, they're no longer raising
they're not at risk anymore in that sense as they were 12 months ago.
But this is very important. They're also not what they were 36 months ago or 3 years ago. They're not sucking up all the excess capital in the system. Remember those huge property companies, they just release bonds, made flats, release. That's not going to happen now. Yeah. So that capital's got to go somewhere else. And so, that's a really important underlying trend that's kind of hard to miss in the daily noise about tariffs. So look, that's very exciting. Let's try and sort of walk away a little bit from China. I want to ask you, we've seen this in previous cycles where China just hoovers up all the investor interest and kind of hoovers up all the opportunity. Yeah. We'd rather have a much more broader recovery in the region, or we're already recovering. But so, when you look around, let's start in ASEAN, India. What can the south of Asia do to not be ignored again?
Well, I think there's two things they can do. And India does this, I think, already pretty good. But ASEAN could do it, I think, a better job in that as a group, is that they need more homegrown companies to list. And in India, we've had many IPOs. In ASEAN, that level is much, much lower. But you need to broaden these markets out because the capital is available. You need to suck that up and then bring that back into the market. That's the first thing. But I also think these companies need to go and sit down and think, hey, Asia is reshaping. There are some globally competitive companies coming out of China. And if you are going to heads-on compete with, say, in EVs with the Chinese, or with in say, industrial robots with some of them, or some of the other companies we mentioned earlier on, the industries, in AI, you're competing with some really very competitive companies that are highly innovative, highly cost efficient, and have run massive operations. So I think you need to see that these companies need to rethink what they do. For the Indian companies, I just think what they can do is, in general, to sell product that the Chinese can't sell into the US. And they already do that. There's IT services, they're big in pharma, maybe other sort of medical services they can think of. Or some of the companies might say, hey, we make a unique product that the Chinese don't have. The consumer market is going to grow there. So we try to sell something to that consumer. And in ASEAN, I think they could try to do so as well, but I think that's a bit more difficult actually for them. I think that's going to be a market that buys products from China, that China wants to export. It's sizable, that whole region. And they want to maybe become part of that sort of industry supply chain. So China makes the EV, but already we know that the Indonesians are trying to make the nickel and process and try to do battery making and these sort of things. So they try to hook on to that.
And we already know a lot of capacity has moved out of China into Vietnam.
Yeah, Vietnam and some of that Malaysia in semiconductors, for example. So we see the early sort of contours of that new sort of, new Asia starts to emerge and new trading routes and these sort of things, connections.
And the equity markets in those countries tends to be more domestic demand focused, local consumer, where you've written about in the past in India. It's actually very hard for outsiders to get into the Indian consumer market because distribution can be challenging, local tastes change very quickly. So those markets internally, they've still got a long way to go to fulfill all the demands of the people in those countries. Now, what about Korea and Taiwan?
Well, Korea and Taiwan is slightly different, and you could throw Japan in there as well, because they've, of course, been very US-centric in selling their product, or very global, and they will remain to be. But they have this sort of competitive edge in certain products, right? We know in Taiwanese making particular sort of chips, and the Koreans in memory and other tech products and cars and these sort of things. So I think that's where they can compete and still remain incredibly competitive. But they have to look around look around their shoulder, right? Because mainland Chinese are emerging, so they got to try to stay ahead. But they have technical expertise that clearly it is very difficult for mainland China to catch up. So the region is reshaping, and a new sort of Asia emerges that is partially, as we said, financed by Asia as well.
And what really gets me is that the surface discussion is trade tension. And we've tried, all of us, to consistently say, yeah, but markets are actually different. Listed corporate Asia is in a very different place. The capital base is in a very different place to where it was either in previous cycles. We did GFC, very different environment back then. Yeah. And it's like this story is being lost with this daily obsession. Oh, is it 92%? Is it 136? Will it go in 9 months? And of course, I don't want to say, we don't care. Of course we care. And it's hugely impactful for many people and many businesses. But if anything, it's going to accelerate this.
Yes, because the competition between the two giants is going to further intensify, and these companies will be in the crossfire. And sometimes they will be good, sometimes will be bad, but they are strong enough to withstand that. They are innovative and cost efficient.
That's exactly where we came in. Is remarkable strength in this market, either year to date or since the worst of these things were announced. We're okay. Exactly. And this is what we said in the very beginning, right? So the Chinese market is down actually only 4% since the beginning of this month. The US is down. Similar.
Exactly. Yeah. And actually the rest of Asia is up. So the markets are seeing this, understanding this to a large extent. Yeah. That's good. Fantastic. I think this is a really interesting sort of topic that we need to revisit at some point in time, because it's a new sort of Asia that is being built up from the bottom, and we're right here in the midst of it. Thanks a lot for being on, Eliot.
Thanks, Harold.
And that's a wrap for today's episode, ladies and gentlemen. A pleasure having you with us here under the Banyan Tree. Please do listen, like, and subscribe if you haven't done so already. You can also find the Macro Brief wherever you get your podcast. That's our sister podcast focusing on the week's key global economic talking points. Under the Banyan Tree is an HSBC Global Research production. We'll be back again next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.